What if building a powerful investment portfolio was as simple as buying just 5 funds? Chart increasing. Many millionaires in the United States build wealth using ETFs because they are simple, diversified, and beginner-friendly. Yet most beginners still pick the wrong investments and miss out on long-term growth. The good news is that a few carefully selected ETFs can give exposure to hundreds or even thousands of companies instantly. ETFs, or exchange-traded funds, are one of the easiest ways to start investing in the stock market. Instead of picking individual stocks, a single ETF can track an entire market index. For beginners, this means lower risk, instant diversification, and long-term growth potential. In this video, discover 5 powerful ETFs that many beginners use to start building wealth. These funds cover the entire market, the biggest U.S. companies, international stocks, and even dividend income. By the end of this video, viewers will know exactly which ETFs to consider and how they can fit into a simple beginner portfolio. Show animation of stock market dashboard and rising charts. Section 1, Total Market ETF, the ultimate beginner investment. The first ETF many beginners consider is the Total Stock Market ETF. One popular example is the Vanguard Total Stock Market ETF. This single ETF gives exposure to thousands of companies across the entire U.S. stock market. That includes large companies, mid-size companies, and small businesses. Show animation of many company logos forming one portfolio. Why beginners like this ETF? Instant diversification. Low expense ratio. Long-term growth potential. Instead of trying to pick the next big company, this ETF invests in the entire market. Historically, the U.S. stock market has delivered about 8 to 10% average annual returns over long periods. For many investors, this one ETF can already form the foundation of a portfolio. Show long-term chart trending upward. Section 2, S&P 500 ETF, the most famous index. The second ETF focuses on the largest companies in America. One of the most well-known examples is the SPDR S&P 500 ETF Trust. This ETF tracks the famous S&P 500. That means it includes about 500 of the biggest companies in the United States. Show logos of tech companies appearing. Examples of companies inside this index include Apple, Microsoft, Amazon. These companies dominate the global economy. Many retirement accounts and institutional investors hold S&P 500 ETFs because they represent the core of the U.S. economy. For beginners, this ETF offers strong growth with broad diversification. Show bar chart comparing index growth over time. Section 3, Dividend ETF, Passive Income Strategy. Some investors prefer ETFs that generate consistent income. Dividend ETFs focus on companies that regularly pay shareholders. One popular option is the Schwab U.S. Dividend Equity ETF. This ETF invests in companies known for stable earnings and strong dividends. Show animation of cash dividends flowing into an account. Examples of dividend companies often included in such ETFs include firms like Coca-Cola and PepsiCo. Why dividend ETFs are attractive? Regular income payments. Less volatility than growth stocks. Long-term compounding potential. For beginners who like cash flow while investing, dividend ETFs can be a great addition. Show coins stacking up. Section 4, International ETF, Global Diversification. Many beginners invest only in U.S. companies. But global diversification can reduce risk. One ETF designed for this purpose is the Vanguard FTSE All-World ex-US ETF. This ETF invests in companies outside the United States, including Europe, Asia, and emerging markets. Show world map highlighting different regions. It includes businesses from countries like Japan, Germany, China. Global markets grow at different speeds. By investing internationally, portfolios become more balanced. Many long-term investors allocate 20 to 40% of their portfolio internationally. Show global market comparison chart. Section 5, Nasdaq Growth ETF, High Growth Potential. The final ETF focuses on high-growth technology companies. A popular example is the Invesco QQQ Trust. This ETF tracks the Nasdaq 100. Show futuristic tech animation. This index includes many of the world's most innovative companies, such as Nvidia, Tesla, Meta Platforms. Technology has been one of the fastest-growing sectors of the last decade. However, tech ETFs can also be more volatile, meaning prices may move up and down more quickly. For beginners, this ETF can add growth potential to a diversified portfolio. Show tech stock growth animation. Bonus tips. Here are a few extra tips beginners should know before investing in ETFs. Tip 1. Start with consistency. Investing every month can be more powerful than trying to time the market. Show dollar cost averaging animation. Tip 2. Focus on long-term growth. Short-term market drops are normal. Long-term investors often benefit from staying invested. Tip 3. Use tax-advantaged accounts. Accounts like retirement plans in the United States can provide tax benefits. Tip 4. Keep fees low. Low expense ratios mean more money stays invested. Show comparison of fees over time. Tip 5. Diversify. Combining total market, international, dividend, and growth ETFs can create a balanced portfolio. Display example portfolio pie chart. Another important thing beginners should understand is how to combine these ETFs into a simple portfolio. Bar chart. Show portfolio pie chart animation. A beginner portfolio does not need to be complicated. Many successful investors simply combine a few ETFs to create a balanced strategy. For example, 40% total market ETF, 30% S&P 500 ETF, 15% international ETF, 10% dividend ETF, 5% growth ETF. This type of allocation gives exposure to thousands of companies across the world. The total market portion could include funds like the Vanguard Total Stock Market ETF, which covers almost the entire U.S. market. The large cap exposure comes from funds that track the S&P 500 through ETFs like SPDR S&P 500 ETF Trust. Show animation of diversified portfolios spreading across sectors. International exposure can come from ETFs such as the Vanguard FTSE All-World ex-US ETF, which invests in markets outside the United States. Dividend income can be generated through funds like the Schwab US Dividend Equity ETF. And growth exposure from technology-heavy funds like the Invesco QQQ Trust. Together, this strategy provides diversification, income, and growth potential. Show animation of portfolio value rising over time. Another key strategy beginners should remember is dollar cost averaging. Instead of investing a large amount at once, investors add money regularly every month. Show calendar animation with monthly investments. For example, investing $300 every month into ETFs can grow significantly over time because of compounding. If the portfolio grows at around 8% annually, that consistent investment could turn into hundreds of thousands of dollars over decades. Show compounding growth chart. Beginners should also avoid one common mistake, trying to time the market. Even professional investors struggle to predict short-term market movements. Many long-term investors focus instead on staying invested during market ups and downs. Show stock market dipping then recovering. Over decades, the overall trend of the stock market has historically moved upward. This is why patience is one of the most powerful investing strategies. Show long-term market chart rising. Another helpful tip is rebalancing the portfolio once or twice a year. Over time, some ETFs may grow faster than others. Rebalancing means adjusting allocations back to the original percentages. Show pie chart adjusting automatically. This keeps the portfolio balanced and aligned with long-term goals. Finally, beginners should remember that investing is a long-term journey. Even small investments can grow significantly when given enough time. Show seed growing into a tree animation. The combination of diversification, consistency, and patience has helped many investors build wealth over decades. And ETFs make that process simple, low-cost, and beginner-friendly. As the portfolio continues to grow, something powerful begins to happen: compound growth. Chart increasing. Show animation of money multiplying over time. When investments earn returns, and those returns begin earning returns as well, wealth can grow much faster than most beginners expect. For example, investing $500 per month into diversified ETFs with an average return of about 8% could potentially grow to over $700,000 in 30 years. Show long-term compounding chart rising steadily. This is why many financial experts emphasize starting as early as possible. Time in the market often matters more than timing the market. ETFs like the Vanguard Total Stock Market ETF and the SPDR S&P 500 ETF Trust allow beginners to invest in hundreds of companies at once, reducing the risk of relying on a single stock. Growth-focused ETFs such as the Invesco QQQ Trust provide exposure to innovative companies that have helped drive much of the market's expansion in recent years. Show futuristic tech company visuals. Meanwhile, dividend-focused funds like the Schwab U.S. Dividend Equity ETF can provide steady income while continuing to grow. And international ETFs such as the Vanguard FTSE All-World ex-US ETF help investors stay diversified across global markets. Show world map with investment flows. Together, these ETFs can form a simple but powerful beginner portfolio. The key lessons remain simple. Invest consistently. Stay diversified. Think long-term. Keep fees low. Show calm long-term investing animation. Many beginners believe investing is complicated, but ETFs prove that building wealth can actually be simple and accessible. By focusing on a few well-diversified funds and allowing time for compounding to work, investors can steadily build financial security. Show peaceful financial freedom seen overlooking city skyline. And that's why these 5 ETFs are often considered some of the best starting points for beginners entering the stock market. Money bag bar chart. Consistency, patience, and diversification can turn small investments today into meaningful wealth in the future.